Welcome to the Commodities Institute podcast. I'm Emily Costa, and I am thrilled to have you with us for today's deep dive into the fast-moving world of global resources. It is Monday, April 6th, 2026, and if you've been watching the headlines lately, you know that we are living through one of the most volatile periods for commodities in recent memory. The geopolitical landscape is shifting beneath our feet, and today we are going to break down exactly what that means for everything from the aluminum in your soda can to the grain on your dinner table. We have to start today with a look at the industrial metals sector, which is reeling from significant physical disruptions. Emirates Global Aluminium has just delivered a sobering update regarding its Al Tawila smelter in the United Arab Emirates. Following a devastating attack late last month, the company now estimates that fully restoring primary aluminum production could take as long as 1 year. This facility had to undergo an emergency shutdown and evacuation, and the process of repairing infrastructure and progressively restoring reduction cells is a monumental task. This news comes on the heels of the biggest monthly price rise for aluminum in nearly 2 years, with benchmark prices on the London Metal Exchange gaining over 10% in March alone. While the refinery and recycling plants might see an earlier restart, the loss of primary production from a region that typically supplies 9% of the world's aluminum is a massive blow to global supply chains, especially with the Strait of Hormuz effectively closed to these shipments. While metal supplies are tightening, the United States government is making a major move to adjust how those materials enter the country. President Trump has signed a proclamation adjusting national security tariffs on steel, aluminum, and copper imports. The headline here is a move towards simplicity and enforcement. While the 50% import tariff remains on raw commodity imports, the administration is drastically cutting rates for derivative products. For example, if a product contains less than 15% metal by weight, like a perfume bottle cap or a small dental blade, the duty is being eliminated entirely. For metal-intensive goods like washing machines or gas ranges, the tariff is being reduced to 25%. This is a clear attempt to ease the burden of domestic manufacturers who have been struggling with a complicated regime, though it remains to be seen how the markets will react to these costs being applied to the full sales value of the imports. Moving over to the power and gas markets, Italy is currently caught in a high-stakes energy scramble. Because of the ongoing conflict and the closure of the Strait of Hormuz, Italy's long-term liquefied natural gas deliveries from Qatar have been severely disrupted. Qatar Energy has even signalled it may have to declare force majeure on some contracts for up to 5 years. However, a lifeline is coming from across the Atlantic. Starting in June, Italy will begin receiving liquefied natural gas from the Golden Pass facility in Texas. This joint venture between Qatar Energy and ExxonMobil is perfectly timed as the facility just produced its first gas. It is a fascinating pivot that highlights how the United States is stepping up as a primary energy guarantor for Europe. But this relief comes at a cost. European gas prices have surged more than 70% since the war began, prompting 5 European Union nations, Germany, Italy, Spain, Portugal and Austria, to call for an EU-wide windfall tax on energy company profits. They want to use these funds to provide relief to consumers who are feeling the pinch of what some are calling a price shock similar to the 2022 energy crisis. The ripple effects of these energy costs are now being felt acutely in the agricultural sector. The Food and Agriculture Organization recently reported that world food prices climbed in March to their highest level since September of last year. While global cereal supplies are currently ample, the real concern is the future. High energy prices are driving up the cost of fertilizer, and if this continues, farmers may be forced to plant less or switch to crops that require less intensive feeding. We're already seeing this in the wheat markets, where worsening crop prospects in the United States and high costs in Australia have pushed prices up. Even sugar is seeing a jump, not necessarily because we are running out of it, but because high oil prices are encouraging producers in Brazil to divert sugarcane into ethanol production instead of food. Despite the chaos, there are some pockets of resilience. In Ukraine, grain deliveries to Black Sea ports actually rose by 9% in March. It is a testament to the logistical fortitude of the region that they managed to deliver 2,740,000 metric tons of grain to ports for export last month. Meanwhile, in the palm oil market, Malaysia is seeing its inventories drop to an 8-month low. This isn't due to a lack of trees, but rather a massive 38% surge in exports as buyers flee the higher export levies in Indonesia. It just goes to show that in commodities, when one door closes or becomes too expensive, the market always finds another way through. Finally, we have to address the elephant in the room, the oil market. OPEC Plus met recently and agreed to a quota increase of 206,000 barrels per day for May. But many analysts are calling this move purely academic. Why? Because the war has effectively shuttered the Strait of Hormuz. For heavyweights like Saudi Arabia, the UAE, Kuwait and Iraq, an increased quota doesn't mean much if the world's most important oil artery is blocked. We are seeing crude prices hovering near a 4-year high of $120 a barrel. And JP Morgan has warned that we could see a spike above $150 if the disruption persists into mid-May. While Iraq has reportedly seen at least one tanker pass through the strait under an exemption, the risk remains too high for most. This instability in the Middle East is driving a massive surge of interest back toward North American assets. We are seeing a high-stakes bidding war brewing for a majority stake in the Shenandoah Deepwater field in the Gulf of Mexico. Energy giants like Shell, Total Energies, BP and Chevron are all reportedly eyeing this project. Shenandoah is what they call ultra-deep water, with reservoirs sitting 30,000 feet deep under intense pressure. It is technically challenging, but in a world where the Middle East is a flashpoint, a field that is already producing 100,000 barrels a day and is far from the conflict zone, is becoming a priceless asset. It is a clear signal that the industry is looking for security and stability, even if they have to drill 5 miles down to find it. That brings us to the end of a very busy Monday. The common thread across all these sectors is a world trying to remap its supply lines in the face of unprecedented geopolitical pressure. From the refineries of the Gulf to the wheat fields of the Midwest, the war premium is real and it is reshaping the global economy in real time. If you found this episode valuable, be sure to subscribe, share, and leave a review.